In this video, I'm going to tell you exactly what drives a stock price higher. And it's not chart patterns, it's not any fake magic or any other stupid word online. I'm going to tell you exactly why a company might grow and how it reflects in the stock price. Now, how do I know this and why should you listen to me? I was mentored by the Institute of Trading and Portfolio Management ex-Goldman Sachs traders Anton Creel and Edward Scheck, and the portfolio manager of Dragonstone Capital based out of Singapore, managing $3 billion. In addition to that, I have completed multiple specializations and have also created my own algorithm which is running in the markets, which has generated me over a 7,500% return over the last 15 years, all of which you can find in the bio. So just using common sense, we know that the more money a company makes, the more likely it is to grow. So revenue, that's important. Revenue and profit. That's the first metric you need to look at. The second metric is the potential to earn more revenue in the future. That's earnings. So revenue and earnings. Those are the two metrics you need to look at to make sure that a company is growing and that is reflected in its stock price. I've read Warren Buffett's shareholder letters and I've read Benjamin Graham's The Intelligent Investor. And I strongly agree with the notion, with what they say, is that you shouldn't be looking at the company as just like a stock. You should really be looking at as a business. If you think it has like a repeatable business model, whether you think the company is actually valuable. Like when I say good business, I mean like what comes to your mind first? You'll probably think, yeah, Apple, Microsoft, Nvidia. That's exactly it. Your intuition's correct. Those are good businesses, repeatable business models, growing in the future. Now, it's not just earnings and revenue. Earnings and revenue would basically give you like a broad picture as to like, okay, is this a good company? Now, if we're looking at, say Yahoo Finance, and this is like, I'm going to get really practical here, like practically like exactly what the you can do right now to basically understand and like get like a list or a watch list of stocks. So if you go on Yahoo Finance, go on analysis, you'll be able to look at these forward-looking metrics. And I'm going to tell you exactly which ones you should be looking at. So earnings. Earnings, you can look at EPS and you can look at forward EPS, earnings per share estimates. A growing EPS is it's good. That basically shows that like a company's earnings are improving in the future. And those are the estimates which analysts have put. What EPS exactly is, I'll be discussing in another video, but that is one metric you should be looking at. You should be looking at price to earnings. This is a ratio which is so misunderstood by so many people. Online, you should be looking at low PE companies, basically companies which are cheap with high growth potential. That doesn't exist. You need to scratch that idea. You should be looking at high PE companies, and the forward-looking PE should be slightly lesser than the current PE. Why? Price to earnings is basically the price of the company or the stock price of the company right now divided by its earnings. Now, think about it logically. If a company's earnings in the future are likely to be higher, and that's in the denominator, is the ratio not supposed to be lower? Exactly. So what you need to be looking at is the current PE should be higher than the industry average. And the forward-looking PE for that company should be lower than what it is right now, because a higher earnings is a higher denominator in that fraction, and that's like an overall smaller number. So that's what you need to be looking at for a PE. So we have PE, we have EPS. Now, apart from earnings and revenue, the other third most important metric, which I think, and so does Warren Buffett. Now, what is operating margin? Operating margin is basically the difference between how much they make on the product, like the amount they get for selling that product, subtracted by how much it costs them to make it. Now, that's the margin, that difference. Now, you can either increase that number by increasing the value or increasing the price of the product, or somehow decreasing the cost, the price it costs you to make that product. These are the two ways you can improve the operating margin of a single product, and that is a very important metric you should also be looking at. Now, there are a couple of other important metrics you should be looking at, which I won't be breaking down in detail, but just to give you an overview: return on invested capital, ROIC, return on equity, the current ratio, and the quick ratio. These are, I think, the most important metrics you should be looking at. I've been looking for this information online and I just don't see anyone talking exactly what metrics you should be looking at, why you should be looking at those metrics. They'll just beat it on the bush talking about why you should be long low PE companies. It's just on this channel, I'm giving you practical advice you can take and apply right now. By now, it should be very clear to you that if you want to make money in the financial markets, you need to do a lot more work than just looking at what the RSI level is or whether we have a MACD crossover. To buy stocks and to actually secure your pension in the future, this is the level of work you need to do. Stop being lazy and actually start looking at these numbers, and I can guarantee you, you will make money and you will be invested in good businesses, and you'll be no different to Warren Buffett. And like I said in a previous video, a quote by Charlie Munger: money is not made in the buy, it's not made in the sell, it's made in the wait.